Dear friends, welcome back to PMS Insights. In this edition of PMS Insights, we would like to address the concerns with respect to the ongoing turmoil in the financial sector and how our portfolio is positioned. A few recent events, ILFS default and outflows from debt mutual funds have triggered fears of a potential liquidity crisis. Further, the market is fearing the likelihood of RBI capping NBFCs' access to short-term instruments. Consequently, NBFCs have been under severe pressure, corrected 30 to 40% over the last few weeks. However, in this backdrop of extreme uncertainty, the markets have penalized all NBFCs without making any distinction between the business models. While we do agree that some NBFCs have been big beneficiaries of this debt market boom and lower rates and could potentially face some growth or margin decline, we should not paint all the NBFCs with the same brush. In our view, well-run business models with stronger balance sheets, prudent risk management practices, and limited earnings risk will emerge stronger. Also, the most vulnerable NBFCs would be the ones with significant ALM mismatches and low pricing power in the asset side. Most of the housing finance companies and wholesale financing NBFCs would come under this category. On the other hand, retail lending segments such as microfinance and two-wheeler segments where demand environment is strong and pricing power is reasonable are expected to remain resilient. RBI has taken several measures to ease the near-term liquidity pressure. However, we believe liquidity conditions may remain tighter than seen in the recent years. Government intervention and ILFS board restructuring could improve market confidence, though resolution could be complex and prolonged. We believe the risk of systemic credit default seems remote at the current juncture. However, if the liquidity crisis is prolonged, we may see elevated credit risks emerging and will have to be watchful about the same. NBFCs which offer liquid, high-quality paper may sustain the current borrowing mix. However, others will have to increasingly rely on bank borrowings to fund their growth. While we have healthy exposure to NBFCs in our portfolios, we expect that most of them should provide healthy absolute returns over the next few years. Our highest exposure is to NBFCs like Bajaj Finserv, Cholamandalam Finance and L&T Finance Holdings, which are large promoter-backed entities with strong credit ratings, low CP exposure and healthy ALM profile. We believe such companies would be able to sustain their current growth momentum even in such challenging times. While the dependence on CPs and short-term funding is relatively higher for JM Financial and Manappuram Finance, these companies continue to have strong balance sheets and minimal asset quality risk. In our view, the current valuation of these stocks are pricing in any near-term margin pressures and they should bounce back from the current levels. Also, we don't have any exposure to housing finance companies where the pressure in yields could be the highest along with negative ALM. We shall continue to monitor the liquidity and credit scenario over the coming days and take action if needed. Thank you.